Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm an education coach and senior manager here at Schwab, and this is Advanced Charting Techniques. And today, we're going to be combining 3 technical tools into one example trade system. I call it the TVM system, known as the Trend, Value, and Momentum System. 3 indicators in one. Should be a good discussion. I think at least one of these indicators is going to be new to most of those here in attendance today. Something called a triangular moving average. Go ahead and chat in and let me know if you've heard of the triangular moving average before. But before we dive into that, let me first of all say hello to everybody who's out there in YouTube. Hello, live audience, Will, TMTM, Villager, David, Ricebird, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If this is your very first time in the live session, welcome. It's great to have you here. And if you're watching on the YouTube archive after the fact, if you're just watching the recording of this discussion, well, enjoy the presentation. Be aware that you're invited to join us in a live discussion. This one is a Friday webcast series that kicks off at 1 Eastern time. We'd love to have you here in the live stream. And I also want to let you know that my very good friend Scott Thompson is going to be hanging out in the chats with the live stream audience, answering any questions that I can't get to. He's already offering some technical tips. I'll have to see if I can get to those, because I think it's going to tie in nicely, Scott, with today's discussion. But yeah, I do want to issue a final invitation to you, whether you're watching the live stream or the archive. If you're not following me on X, please do that. It's the best place to connect with your favorite presenters in between the live streams. You can find me there on X at Cameron May CS. All right. But let's get right in there. Let's get right into it. Will, you haven't heard of that indicator before, the triangular moving average? Well, I'll bring everybody along in just a moment. But the first thing that we need to do is to consider the risks associated with trading. This is important information, so bear these disclosures in mind. The information here is for general informational purposes only, should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as sole means of investment research. Investing involves risks, including a loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. So let's set the agenda for the day. Now, as I mentioned, we're going to be introducing, well, a combination strategy of technical indicators. I call it the TVM strategy. Others might have their own names for it, but we're going to be talking about trend, value indicators, and momentum indicators. So we're going to go through each one at a time. We're going to start with our triangular moving average, talk about its construction and then its application. It's going to be our trend tool. Then we're going to get into the value tool, and finally the momentum tool. Combine all 3 into a system. And then we're going to look at some example charts, planning entries and exits. We're going to place an example trade before we wrap things up. So that's what we're going to be doing today. Let's go right to the Thinkorswim desktop software platform. All right, so Ricebird says geometry. I love that stuff. You haven't heard of using it in the charts. Yeah, so let me apply a triangular moving average here to our charts. I'm going to come up here and click Edit Studies. And again, the purpose of moving averages very commonly is to identify the trend of a chart. Now, some traders prefer a simple moving average. Others might use something known as an exponential moving average. Still others, though, will use this indicator known as a triangular moving average. So to find it in our tools, I'm just going to start typing in the word triangular. Even TRI will narrow the menu down to just a few here. And I'm going to select moving average triangular, abbreviated to MOV AVG triangular. So if you're following along at home in your paper money, that's what we'd select. And I'm going to add 2 of these to this chart for today's discussion. So the first one, let's make this a 50-period triangular moving average. So I'm going to leave that one on the green default. I'm also going to leave it the standard width of 1 out of 5 width. But to distinguish our second one, let's come up here, make our second one a 100-period triangular moving average. I'm going to make this one a little bit thicker. Let's make this a 3 out of 5. Let's change the color. I don't know, something that stands out from green. Let's go for a purple. Click OK, click Apply, and click OK again. So here's what we're left with. Just 2 moving averages. And I want you, first of all, for those of you who use simple or exponential moving averages in your trading or if you practice trading, what looks different about this 50 and 100 combination of moving averages here that might look a little bit different than what you've seen on a simple and an exponential? I don't expect everybody to know exactly what I'm talking about right away, but these are smoother moving averages. These are averages that are typically recruited by traders who would prefer a moving average that's not as sensitive as a simple, certainly not as sensitive as an exponential. This is actually a moving average that is slowed down, built on a foundation of a simple moving average. So I do want to talk about how these are constructed. So we'll just use our 50. Yeah, Crispy, it's definitely smoother, right? Just looks, well, what I mean by smoother is it just looks, it's just undulating, right? Flowing across the chart instead of sort of a jagged visual presentation on the chart. It is a moving average that has been slowed down as a max. As a matter of fact, sometimes it's referred to as a double smoothed moving average. Doesn't that sounds like twice whipped potatoes, if that's such a thing. I don't know if there is such a thing. I'm not a cook, so I don't know. Maybe I just made something up. Anyway, how do we construct? Let's talk about calculating or constructing a triangular moving average. Now, there are some indicators that are kind of complicated. Others, to me, are more intuitive. This definitely falls in the latter category. I think most of you are going to latch right on to this. I'm going to abbreviate this to MA if you'll forgive me. Good grief if I can type. There we go. Calculating a triangular, not a triangular. Boy, I'm in trouble here today. Anyway, calculating a triangular moving average, and it does sort of start with a simple moving average. So if you know what a simple moving average is, you know that it's calculated just using the closing values from day to day over a prescribed period of time of 50 or 100 or 20 or 10 or whatever we choose. Well, for some traders, they ask themselves, so what's so magical about the closing price of a stock? That's just one point of data over a whole day's worth of trading. So instead, they may recruit something like this. So a triangular moving averages actually uses the simple moving average as its basis. There we go. So let's roll the clock back to day one. If we're using a 50-period moving average, let's go back to that first day out of 50. And instead of using the closing value to calculate the moving average here, it actually uses the simple moving average value, whatever it might have been back there on day one. And then it just adds that, very much like a simple moving average. It just adds that to day two. It's just that instead of using the closing values, it's using the simple moving average values from those times. Day three, it adds that to the first two, not a DMA, but an SMA, and so on, all the way through day 50. And then finally, we run a total of those values. So we take the day one simple moving average value, add it to the day two simple moving average value, add it to the day three simple moving average value, all the way through day 50, get a total, and then just divide it by the number of days. So that should sound very similar to the construction of a simple moving average, but it's just smoothed out. It's a moving average of a moving average, basically. So that results in this smoother trend line. And so for some traders, they'll see this as being less reactive, hopefully generating fewer entries and exit signals, generating fewer trend reversals, but hopefully of a higher quality. That's the objective. It obviously no technical indicator carries a guarantee of, enhanced performance. No technical indicator carries a guarantee of performance on an individual trade. But that is the basic concept of a triangular moving average. And that's, I think, to me, that the concept matches the intended use. So perfect. So what we've done here is we've added a 50-period triangular moving average. We'll just abbreviate that to TMA. And we've added that 100 period. So our 50, just like with a simple moving average or an exponential moving average, might be intended to gauge, let's say, an intermediate trend. And as long as that green line, in this case, that's our 50, is moving higher, the trader may conclude that that intermediate trend is still intact, even in the face of activity like what we're seeing right here. Now, Scott pointed out, hey, if we start getting lower highs and lower lows to some technicians, Scott actually chatted this in before the webcast started. That's what I'm referring to. Said if we start getting lower highs and lower lows on a chart, to some technicians, that might mean a trend change. That's very true. For other technicians who rely on indicators, they might need to see the indicator itself shift. Or when they have two trend lines, as we have here, as long as the intermediate is above that longer term, even if the intermediate is downturned, our trend might be seen as being intact. All right, so that's what we're looking at here. Our trader, conceptually, as they're attempting to employ this trend, value, and momentum strategy, first thing to do for them might be to confirm which way they think the trend has been headed. And the specific definition in the application of this is, let's list this down here. Our trend confirmation is just the 50 TMA above the 100 TMA, triangular moving average. So look at what's going on with the S&P right now. I wanted to use the S&P as our example because there's some interesting things happening through the lens of a TVM trading strategy. Number one is our 50 triangular moving average still going up despite having possibly a lower high right here on price? Despite having an equal low right here on price, so for some, there may be a little bit of a question mark around whether this S&P trend has started to stumble and has started going down again. Yeah, in this case, our 50 is still going up, and more importantly for this sort of an approach, the 50 is still above the 100. So this would actually be a trend confirmation of bullishness using this approach. Now, next up is in this approach is known as a value confirmation, using a technical tool to identify short-term areas of comparative value versus comparative, I don't know what you want to call it, overvalued situation. So let's apply this to the S&P 500, and this is commonly accomplished using an oscillator of some kind. And one of those, quite commonly used, is the RSI. Now, let me throw this out there for you. Let me get you off the hook. If you weren't familiar with the triangular moving average, nobody knows everything, right? Nobody has applied every technical indicator to their chart. How many of you actually have used or are familiar with the RSI, Relative Strength Index? I'm not going to go terribly far into the construction. I think that for an advanced technical analysis discussion, I'm going to have to assume there's some familiarity with some of these more common oscillators. Now, if you're not, that's okay. Let me click apply, click OK again. But if you're not familiar with RSI, what you can do is make sure that you're subscribed to our Trader Talks channel on YouTube, our Trader Talks Schwab Coaching webcast channel, and you can just come here and do a keyword search for RSI. Okay, Kevin says you're familiar with RSI, but not TMA. Okay, well, Kevin, now you've had your introduction to TMA along with, I think, most others. But yeah, just do a keyword search right here for RSI in this case, and then you can just look for related webcasts. For example, here's my discussion using Relative Strength Index RSI to plan a stock trade. Okay, but among other potential applications for RSI, for some traders, they'll use this as an indication of times when a stock is undervalued in the short term and overvalued. Even within a nice intact upward trend, are there times when the stock is possibly trading at lower points within that trend versus higher points within that trend? Undervalued scenarios versus overvalued scenarios? Conceptually, yes. And so this oscillator sometimes is used to help identify that. Now, I will say, by default, for those that are familiar with this oscillator, we have our black line, that's our RSI line, that's just oscillating up and down, back and forth, anywhere from as low as 0 to as high as 100. But really, when it gets above 70, that's commonly seen as being overvalued in the short term. If we're under 30, that might be interpreted as being undervalued. However, one thing about the RSI is that 30, especially in a persistently upward trend like we have on the S&P and like we have on so many other stocks, getting down below 30 is not a terribly common scenario. So one adaptation that some traders will make here is they'll nudge that oversold, that undervalued line up in a condition like a trigger for this sort of a step might be that our 50 is above our 100 and both are heading higher. Greg says, anybody else having sound issues? I haven't seen any other reports of that, Greg, but keep me posted. So let's snug up this 30 line up to 40. So I'm going to come up here to our little our little flask icon. There's our RSI, and I'm going to click on the gear and change that oversold condition from 30, which is, again, not very common in a nicely upward trending chart, to 40. So let me click OK. Oh, thank you, Journey777. And Andy, you say the sounds good. TMTM, thank you for the confirmation there. But while I'm here, why don't I do this as well? Just so you can see this indicator a little bit better, let's change the thickness of the RSI line from a 1 to a 3 out of 5. Let's do oversold 1 out of 3. Or I should say 3 out of 5. And overbought, let's make that a width 3 out of 5 as well. And click OK and click Apply. All you'll see here is I just thickened the lines, so they're a little bit easier to see. So here's what caught my eye with the RSI. With this rough start that we've had to 2025, actually this rough close to 2024 is probably a better way to put that, starting back here, early part of December, there's that potential lower high, pretty much an equivalent low there. It's interesting where that's taken us relative to our 100 period TMA, but also look what's happened with our RSI. It has crept down, and for our RSI traders, we actually did get down below 40 right here in that third week of December. We also teased at 40. We actually got down to 40.07, 7/100ths of a point from getting below 40. For some traders, what this might tell them is, well, our trend is intact, so T in our TVM acronym. There's also an indication, a technical indication of value. This is an indication that prices have very likely come down in the near term, down to lows that haven't been seen, extreme departures to the downside that are only occasionally seen over the course of a 12-month period. So this might be, for those traders who maybe subscribe to the concept of buying low and selling high, might be an indication that it might be time to look at possibly buying low. So we have trend. We have value identified. Now, our value confirmation specifically is just going to be an RSI in an upward trend with the 50 TMA above the 100, not typically looking for it to get down below 30. That'll occasionally happen, not very often. Instead, the RSI being, let me turn that gator around there, the RSI being below 40, less than 40. And he says, is this applicable to options as well as stocks? Well, we're talking about stocks today, but conceptually this can be used in other approaches, Andy. Yeah. Yep. Now, whether we're using stocks or other things, there's never a guarantee that it's, on an individual trade, it's going to function perfectly. We'll see examples of that today. Okay. But there we go. So we have the T, trend confirmation. We have the V, value confirmation, and I thought it was just interesting that these were pretty much lining up. If we're going to split hairs, it didn't quite get below 40, but for, I think, our traders of a TVM approach, they might say, that's close enough. For some others, they might be a little bit more hard line. Close enough isn't good enough. But I think you see the concept there. And if we look back over time, let's look at history and see, well, here was a time when we got down below 40. This is an example where if we took a trade, we haven't introduced the momentum indicator just yet, But this wasn't too bad. We saw about a week of buying after that last signal or combination. Right down here with our 50 above our 100, look where price was. Now notice, I should make this clarification, this distinction. When using this combination of TMA trend lines, the trader does not typically require that price be above the trend lines, only that the 50 be above the 100. And that can be a little uncomfortable for some. Obviously, any technical approach to trading carries with it some flexibility. The trader should always feel that they can customize as they see fit, and if it's uncomfortable to take a position, even if we're okay with the concept here, if it's uncomfortable taking a position while price is below our moving averages, that's up to the trader to decide. But in this case, the combination of these two did a pretty fair job of identifying right around low times. Andy says, what about applying to other time frames other than just daily? Another great question there, Andy. And when I'm teaching, you'll see that I most commonly, probably, I don't know, 90–95% of the time, I'm teaching from a 1-year daily chart. Now, that's not to say that that's the only time frame that a certain technique can be used. With the vast majority of technical techniques, they are portable from one time frame to another without any real adjustments. So we could just switch. Could we just switch this up to a weekly chart or to an hourly chart? Maybe trade those time frames with the same combination of indicators? Yep. Is it guaranteed that it's going to be better or worse on one time frame or another? Nope. But a good question there, Andy. All right, and then finally, we did have an example here. 50 still above the 100. Our RSI ducked down below 40, so somewhere in this range might have been a time where a trader was looking to take an entry here. You can see that some days appeared to be better than others. We have an indication of value, but at that time, the momentum is still going down. So let's add a third indicator to our tool set here, and this is going to be our momentum confirmation. Okay, and for this one, we're just going to use a familiar indicator in my webcast series, the MACD. Look, did I just touch this mic and it got kind of loud? Anyway, let's come up here to our Edit Studies. Let's add a MACD oscillator, and I'm just going to go with the MACD histogram. If you use just the plain old MACD, there's nothing inherently wrong with doing that. It just shows you two different views of the same data. So the MACD histogram shows this rolling series of highs and lows. The MACD shows that same rolling series of highs and lows expressed as histogram bars, but it also shows two lines, and the interplay of those two lines is just a different view of the same data. It's just a different visual representation of the same data. So I'm just going to choose the MACD histogram, keep it nice and clean, click Apply, and click OK. And so here's what we see. If you're not familiar with the MACD, for some, it is a momentum oscillator. It centers itself around a zero line, goes above that line and below that line. When it's above the line, it's green, light green or dark green. When it's below the line, light red or dark red. And what some traders will look for as a confirmation, well, and just to extend that explanation of the MACD, when we're above that zero line, the momentum is generally seen as being firmly in the hands of the buyers. It's an indication that price is strengthening. But when there is a shift from a light green to a darker green, it might signal that price is getting a little bit top heavy. The buyers might be exhausting themselves, and the sellers may be soon to take control of that momentum. All right? So that's a typical interpretation here. Well, you can probably turn that on its head. Doesn't take much of a logical step to go to the other side here. When we have red, that's typically seen as the sellers being firmly in control. When we have bright red, when those histogram bars are getting further and further below zero, the sellers are seen to have the momentum. Now, if there is what I call a red shift, now you've probably never heard this in one of our webcasts. I've never used this term before, but I've been reading a book about the universe, okay? And there's a concept, in physics that it's called redshift. Tells you how far away a star is or a galaxy is. Anyway, I thought, hey, that's a nifty little term because that's really what's happening here. We're shifting from a bright red to a dark red. If we see a red shift, for some traders, they might see that as being the momentum shifting from the sellers, and maybe the buyers are starting to resume control again. So our momentum confirmation for this approach, and again, the term redshift, don't get too hung up on that. I just thought of that today. Thought, what do I call this? Redshift. That works for me. Anyway, we're going to look for a MACD redshift. Or in other words, the MACD turning from bright red to dark red. So what does that add to our discussion? Well, we have our T for trend. Trend is confirmed, 50 rising, remaining above the 100. The intermediate trend line still strong enough to remain ahead of the longer term trend line. And that might be a confirmation that prices generally continuing to rise, even in the face of a bunch of red candles in recent days. Yeah, Chris B, there are similar indicators. Yeah, and this is it's a good example of how different oscillators can be similar in construction, but they each have their own variations. So for some technical traders, they might just stick with one. Could this just be a trend and a value approach? Yep. But for others, they do like to layer on a second oscillator. Now, when we start to add a third and a fourth and a fifth and a sixth and a seventh technical indicator, what can happen then? If we're looking for 6, 7, 8, 9 things to align all at once, that's where the trader might just get frozen. They're relying on too many things to happen all at the same time, and it's probably not going to generate a lot of trades. That's actually referred to as analysis paralysis. Anyway, but yeah, there are going to be similarities in these indicators and not exactly the same though. For example, there is no lower extremity definition. Where is the oversold territory for the MACD? There isn't one. Okay, but in any case, when our MACD tilts, when it shifts from bright red to dark red, for some, that's the confirmation. Trend is up, the value is there, and the momentum seems to be coming back into the stock. In this case, into the index. So it's kind of interesting for those who use this sort of an approach. They might be looking at the S&P, and as discouraging for the bulls as it has been since that first part of December, it might be equally encouraging that we're getting this combination of technical indicators. Now we'll see if it plays out from here. So I want to look at some examples. Now that we've learned this approach, and that included a discussion of a new indicator, I hope you don't mind me taking a little extra time to explain what that is. Let's go look at some examples out there in the marketplace. And if you're wondering how I found these examples, I simply brought up the watch list of the S&P 500 and just glanced down through them. It literally only took me a minute or two, because someone naturally would say, hey, Cameron, can we do a scan for this? Nope, can't do a scan for a triangular moving average, but what we can do is just bring up a watch list and click at the top of that watch list and quickly move through these and see if there's a combination of these three factors. So here's Apple, the 50 is above the 100, the RSI is close to 40, but it's not below, and there has not been a redshift yet. So that might be interpreted as there is still, despite having an uptrend net to Apple, maybe the stock just needs to find its footing for a little while first. Okay, but same thing can't really technically be said about Costco. What's going on with Costco? Well, our trader here might look and say, well, our intermediate line, upward trending, staying ahead of that longer term line, the 50s above the 100. Our RSI has actually snuck all the way down below 40. Now, a typical trader who might just use the RSI in isolation, they might wait for this to get back up above 40. But our trader who combines that with our momentum indicator might say, not waiting for that, I have my red shift. Do we have a red shift right down here? Yeah, we do. Let me see. There's a discussion going on about swing traders. And by the way, thank you, Scott. I can see all that yellow out there in the chat. I know you've been busy. But yeah, trend is intact. Value in the near term appears to be there. You can see that on our chart. Prices come down substantially from where it was just about 2 weeks ago. But there's an indication now that maybe the knife is no longer falling. Maybe we're getting a bit of a bounce, getting a confirmation of that red shift. Might be time for entry. Okay, so let's buy some Costco in our example paper money portfolio here. But that kind of leads us to our question. If the entry signal is the combination of these three factors, if we're looking for a TVM confirmation, if that's when we buy, when might the trader sell? And there are a couple of approaches to this. One approach is just to look for a return to previous highs, which in this case looks like it's right around $1,000, right? That could be used. Now others, though, will actually use the RSI. They might just ride this from the combination of entries. If we can get back up to that overbought condition, we bought because there was an indication of value from a technical perspective. If that indicator has been turned on its head, if we're now looking at overvalued or overbought scenario, that might be time to take profits. Now, that sort of a disadvantage to doing it that way is that we can't set up the target as readily. It requires more manual oversight. So for this trade, I think what we're going to do, we're some distance below that previous peak. I think we're just going to look to get out up there at $1,000. We could hold out for a few dollars more because it actually did get up to about 1,009, 1,008. I think was the absolute high. Let's just call it 1,000. All right. So let's go do a trade, and let's also plan where are we going to take our lumps if we happen to be wrong. And we're just going to go with this combination of factors carries with it a technical assumption that the trader has caught the low. That's what they're trying to do. Well, if price just turns around and continues lower, maybe they're wrong. Maybe they need to just get right back out. Now, Paul says you can set up a conditional order based on a study. I don't want to go quite that far with this, Paul, but yep. And as a matter of fact, the trader might want to just keep their eyeballs on things because sometimes it can float up close. Let me see if we have some examples here. No, this one touched and touched and touched. Yeah, sometimes we get up close and it's a near miss and then falls back. And an automated approach like that can miss. That's one of the risks of using the automated exits. But in any case, back to placing our stop, where might the trader just admit that they're wrong, that we're not going to get up to 1,000, we're not going to get back up to that RSI high? Well, if price just happens to fall back down below the low, now it's going the wrong direction. So our low recently was right here. We got down to a low of 902 on the nose. Wow, look at that. 902 on the nose. So then maybe the trader gives it a percentage point or two below that. Let's go 1% below that. $9. Below that low would be, that would have us down there at 880 or 893. So we're going to place our stop right down here with our target up there at $1,000. That's our plan. Let's go put it into action. Let's go to our trade tab. And notice how we're not really giving this a lot of wiggle room with just that 1% stop. If we're off by a day or two on our entry, could just get stopped out, get whipsawed out of the trade, and then it could run right up. So the trader needs to bear that in mind, decide whether they're satisfied with where they've placed that stop. So let's go to the ask price. We have an account here, just restarted for the year. It's a $200,000 portfolio. Let's, how about we invest, and really, I've kind of split this into two webcasts that I'm teaching, advanced charting and then my other webcast here. So $100,000 each. How about we invest 5%? Now, 5% of 100,000 is going to be 5,000 bucks, right? That's only going to be about 5 shares on a higher price stock. That's okay. But let's go to our trade tab. Let's right click on our ask price to place our buy order. And we're going to attach a custom couple of sell orders here. Buy custom with stop. We're going to choose, buy custom with OCO bracket. We don't really need this left column anymore, so I'm just going to close that out. Let's cut this down. Let's just do I want to keep this at, I'm just kicking the year off. Yeah, let's keep it at 5% of the $100,000 that I'm assigning to this webcast series. So let's change this to just 5 shares. I'm going to set this as actually a market order. Markets are open. Obviously, there's a risk when we place a market order. We may not be totally satisfied if we get a fill with what we're filled for. But our target, our limit price, we're going to put up there at $1,000. And we're going to make that a good till canceled order. Our stop, we're going to put that at $8.93. Is that right? I believe that was $9 or 1% below our 902 recent low. Let's make that good till canceled. And let's confirm and send this order. So we're buying 5 shares of Costco at the market price. We're going to sell those if we can get up to $1,000, or we're placing a stop down there at $8.93. Some important reminders down here. With market orders, prices can change quickly in fast market conditions, resulting in execution prices that can be different from the quotes displayed at order entry. And with stop orders, there's no guarantee that the execution price, the price that the trade is filled for, will be equal to or even near the activation price. In this case, that activation price is $8.93. So let's send that order off and bought 5 shares of 920 at 920.44. We'll see if this TVM combination gets us up there to $1,000. But we have the time. Let's look at one more. How about Palo Alto? It's always interesting when I start talking. I set these trades up an hour before the webcast. Let's go see how things are rolling along an hour later. But here's Palo Alto. You can see what a rough go this has had in the last 3 weeks or so. Now, a trend trader is using highs and lows. Might they be thinking, boy, Cameron, this is looking a little bit sketchy, possibly. But is our 50 above our 100? It is. Do we have our trend confirmation according to this approach? We do. Has the RSI slipped below 40? It has. Yeah. And do we have a red shift? Let me zoom in here so you can get a little bit closer view. Is there a red shift right there? There is. So trend, value, momentum all seem to be in alignment. Where might we, if we do take a trade, where might we plan to take profits? Well, right up here, there's a previous high right around, I'm going to call it 204. You can see how the stock struggled at that level. You can see it was up there in the overbought territory, right up there around that 204. So that's going to be our target. Where might be our stop? Well, a recent low, yesterday's low, 178.82. If you'll forgive me, I'm going to go 179. And let's give it 1 or 2% below that. So if we're at 179 as our recent low, $2 below that, or 2% below that, might be $4-ish. Yes, I'm doing some rounding. $4 below 179, we'll call it 175. That's going to be right down here. So that is going to be our plan for this trade. Let's go buy some shares. Let's get out our calculator. How many shares can we buy? 5,000 shares divided by 184-ish dollars tells us 27 shares. Okay. Go to our trade tab, right click on the ask price, buy custom with OCO bracket. Let's change our quantity. Did I say 27 shares? I think I did. Sometimes I skip ahead to the next step without making a good mental note, but I think that's right. Let's do another market order. Again, same risk exists here. Target was up there at 204. stop down at 175. I'm going to double check those. Make sure that's what I intended. Yep, 204 and 175. It's exactly right. And let's click confirm and send. Buying 27 shares of Palo Alto at the market. With market orders, prices can change quickly in fast market conditions, resulting in execution prices that can be different from the quotes displayed at order entry. We're not guaranteed that we're going to fill for the 184.24 or whatever is displayed right there at this moment. We're going to sell if we can get up to 204. That'll be our limit order. Sell if we drop down to 175. That's our stop. With stop orders, there's no guarantee the execution price will be equal to or near the activation price of 175. Okay, let's send this off. Now, with both of these, there are no commissions. There are commissions on some types of trades, but I'm going to send that order off. And we're in at 184.35. This will be interesting. We're going to follow up on these trades in the coming weeks, and we're going to learn new technical approaches and trade new systems. But I hope you enjoyed this discussion. I walked you through this TVM combination of technical indicators, trend, value, and momentum. We introduced what to most of you was a brand new indicator known as a triangular moving average. And if this is new to you, maybe go have a look at triangular moving average in your paper money. Load up a stock, load up those three indicators, and give them a run in that paper money. And this is never, when I'm teaching these webcasts, it's never a sales pitch for a specific approach to trading. That's always left up to the trader. But when you're learning something new, it's always good to get some repetition with it, right? All right, but it's time for me to let you go. Everybody, thanks for giving me your time today. I do want to make sure that you're all aware of additional resources that you have out there. It's not just limited to our webcasts. First of all, make sure that you've subscribed to our Trader Talks channel. Trader Talks Schwab Coaching Webcasts on YouTube. Doesn't cost anything to subscribe. You can click on the subscribe button right down below the display window right now. And this is just the best place to find all of our previous webcasts in a nice organized fashion. You can find our playlists right here. You can join the live streams right there. You can do searches for topics of interest using the little search function. Also, make sure that you're following me on X. If you're not following me, well, X is just the best place to connect with me in between these live streams. So you can find me on X at Cameron May CS. And it is the best place to find your favorite presenters in between their live streams. And I should also mention, it doesn't cost anything to follow us there on X either. So final heads up, thank you for how many people? We have 200 people watching, which is fantastic. And we've had 54 already clicked that like button, already clicked the thumbs up. Thanks for doing that. That's always appreciated. To me, I always say it sounds like applause. The thumbs up on YouTube is a way to applaud your presenter for their efforts. But it also helps my webcasts find a wider audience through that YouTube algorithm. When YouTube senses that the audience likes what they're seeing, they'll show more people that webcast. So thanks for clicking the like button. Anytime you like one of our webcasts, give it a quick click and then hit the road. But everybody, I will look for you again next Friday. We're going to be looking at different technical indicators, maybe a combination of different technical indicators next Friday. I have other webcasts every single day of the week. If you want to join me in my other webcast series, that'd be great. But I'll look for you in a future webcast. I'll also look for you on X. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.